Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. How could I not be? There's so much happening in markets. We're loving covering it all.
Always.
Loving learning more and more about investing, loving that we get to do it as a job.
Yeah.
So what have we got today?
Today we are kicking off with a bit of bad news around Australia.
Well, that dulls the excitement.
That dulls it even more. We've got a Pimp My Portfolio with Luke Laretive, which is spicy as always, and then closing out with a company that has come across my desk that I think is pretty interesting.
All right, well, the excitement is right back up there. Before we get into it, we want to say we get a lot of questions about ETFs on the podcast and on our
boys.
We are the index boys. We love a core index ETF, but also on Get Started Investing, a lot of new investors come and join the show and start their investing journey there as well to help you get started, to help you get your head around how to build a portfolio of ETFs, how to build a core portfolio, and then start thinking about a satellite portfolio. We've built out an ETF handbook. It's free to download. The link is in the show notes. So if you or someone in your life wants to get started investing, wants to get their head around ETFs, that can be a really useful resource.
News and markets.
Headlines we're covering today. It's been a tough week for the Aussie miners. There's more bad news for Australian housing. And guess what? Your ice cream is about to get more expensive.
Jeez.
I did say bad news.
Bit of a bad news roundup. We might have to rack our brains and finish with a good news story.
We'll give it our best.
So let's start with the story of Aussie miners, because for both iron ore miners and lithium miners, it's been a tough week. Well, let's start with iron ore because they're the big boys. So BHP, Rio Tinto and Fortescue are three of the big four iron ore miners around the world. Spot test for Bryce. What's the fourth one?
The Brazilian one.
Yeah, Vale from Brazil.
Vale,
yeah, very nice. A lot of their demand has come from China and demand for steel in China over the past few years. We got some data out of China that did not tell a good story. Chinese demand for steel is at its lowest ebb in 8 years.
That is not good news.
That is not good news.
The reasons for it, China's economy is slowing. The property market, which was, I guess, one of the biggest had the biggest demand for steel, they are struggling to recover. And of course, the trade war is creating a lot of uncertainty. And so business investment is also low. All three mining giants were down more than 1% on the day of the news.
Yeah. And look, this is the slowdown in the iron ore market has been playing out for some time. Over the past 12 months, BHP is down about 15%, Rio's down about 14%. They're more diversified as miners. Fortescue is much more pure play iron ore. Their iron ore is also a bit lower quality than some of their bigger peers. Fortescue's down 40% in the past 12 months.
Wow.
Yeah. So, not great news for the iron ore players. The question is, does the cycle turn at some point? Do iron ore prices hold and do some of these stocks start to recover? That's something we'll be watching along with most other Aussies who are in some way, shape or form exposed to these iron ore giants. But let's move to lithium because the story isn't great there as well.
It's not great, and it all stems from a supply issue in the lithium market. There's concern that the lithium market is oversupplied and will continue to drag on the lithium price, a story that's been playing out now for over 18 months.
Yeah, the lithium price is down more than 90% in the past 2 or 3 years.
Crazy.
Yeah.
And the stocks are following. So here in Australia, Mineral Resources down 12%, while Liontown Resources and Pilbara Minerals are down 8% as the market continues to sell off lithium producers, really waiting for a bottom in this lithium price and I guess the supply-demand imbalance to get back to, I guess, more equilibrium.
Yeah, and look, the story is similar here as with the iron ore miners. This has been a story that's been playing out for a while over the past 12 months. Mineral Resources is down 73%. Pilbara is down about 70%. And Liontown is down just shy of 60%. There's a lot of talk. We've actually heard it on this show before that people say 2026 is the year that, because what happens, the price has fallen, so mines will come offline. You know, in theory, supply and demand will equalize and the price will start to turn. That's the mining theory. That's cyclical industries in general. And we're hearing a lot of 2026 is the year that supply and demand will hit equilibrium and the price will turn. If I was thinking about investing in lithium, I would be waiting to see some green shoots.
Absolutely be waiting. The second headline for today is that there is bad news for Australian housing supply, and this came through the latest State of the Housing System 2025 report by the Federal Government's Advisory Council, the National Housing Supply and Affordability Council. Yeah. Wow, what a tongue twister.
National Housing Supply and Affordability Council.
Yes.
Now, you framed this as bad news for Aussie housing, and I think it is bad news for people who want to see prices continue to rise. I guess it's good news for them.
Yes.
But look, the story is the supply story still, and the story is Australia is not going to hit its supply goals. So only 177,000 homes were built in 2024, which was below the government's target of 223,000. Over the 5 years from July 2024 to June 2029, the state and federal governments set a target of 1.2 million new homes. This latest forecast thinks we'll build 938,000 homes over that period. So we'll miss the government's target by 262,000 homes. But I pulled out this quote, Bryce, which I think sums up.
Which to me doesn't sound crazy, but I guess it's that
will fall short.
Yeah, like what I'm thinking here is that 1.2, is that like bang on supply demand, or is that like excess supply? Or do you know what I mean? Like, what's the 1.2 million?
I think it's a target that would have housing supply growing faster than population,
yes,
if that's what you're asking.
Yes, that's what I'm asking, yeah.
But here's a quote from the report, which I think sums up the vibe. Quote, scenario analysis indicates that even under optimistic economic scenarios, the target will not be achieved. No state or territory is forecast to meet the share of the target implied by its population.
Damn. That's no good. A lot of work ahead for the government.
Yeah, so that report got released, and then a little bit after that, we got the data from building approvals for April. Economists were predicting a 3.1% growth in building approvals. Fell 5.7%.
Damn.
Yeah.
Damn.
Wow. We continue to drift further from the target.
Yeah, it does feel like that, doesn't it? The further the targets are set, we don't achieve them. They set new targets, we don't achieve them, and the cycle continues. It's tough.
Rates get cut. Supply is constrained. Rates get cut.
Yeah.
There was also data, which we actually didn't include in this, but we included it in one of our emails this week, just a plug to sign up for our daily emails. Equifax, the credit reporting agency, shared the data on mortgage pre-approvals for March.
Yeah, up 25% or something.
Yeah, up 24%, year on year. And that was before the second rate cut.
That was anticipation.
Yeah.
Yeah.
So, now we've had a second rate cut. More rate cuts seem to be on the horizon. I can only imagine those mortgage pre-approvals are going up. So you add that in, more buyers are entering the market, supply remaining constrained, and those buyers having more buying capacity because rates are cut. The Australian property fascination remains undefeated.
These Tesla robots can't come soon enough. Get an army of them out there building.
Oh, I was wondering where the connection was.
We need an army.
Well, look, we've spoken about tough weeks for miners. We've spoken about tough news for Aussie housing supply. Let's close it out with some more tough news, particularly for you, Bryce. Your ice cream cone is about to get more expensive.
My Maxibon, actually, Ren, is about to get more expensive.
That's your go-to.
Yeah, love a Maxibon. I'm actually trying their new ranges at the moment. Recently had their vanilla slice. Don't recommend. Stick to the tried and true. Anyway, yes, bad news. So ice cream is about to get more expensive, and that's because a key ingredient in ice cream, which is coconut oil, is at record highs after nearly doubling in the past 12 months. It's also roughly 200% higher than its average price between 2000 and 2020.
Yes.
So 200% higher than a 20-year average.
Yes. So coconut oil is the key ingredient we're talking about here. Its price is absolutely rocketing up. The question is why? And this story starts in the Philippines, which is responsible for 45% of the world's supply of coconut oil. The Philippines has had bad weather recently over the past couple of years that has affected supply. The Philippines has also passed new laws around biofuels. And so more of the supply, the limited supply that is being produced is now being directed towards biofuels, which is obviously constraining supply for ice creams, but also the beauty products boom. Coconut oil is used in a lot of beauty products. And so again, that is increasing demand. All these factors increasing demand, limited supply, unsurprisingly, the price is rising. The one thing that may work in our favor is that ice cream is a pretty consolidated industry controlled by a few giants.
Big guys.
And Unilever and Procter & Gamble in their latest earnings call both acknowledged there was cost pressures coming in, but that they were, they're not doubling the price of ice creams. They're saying 1 or 2% price rises at this stage.
Yes, at this stage.
And their talk around managing costs, the input price increases was obviously couched in a broader conversation around trade wars and tariffs as well. So
the ice cream goes up, they'll just squeeze the chocolate makers.
Yes. Well, I mean, talking of chocolate is interesting. I think for me, we're getting echoes of this story more and more. So chocolate last year, and that was because there was drought in West Africa, and that was that saw cocoa prices absolutely rocket up. But in the last few years, we've had coffee, and we've also had olive oil as well.
Yes.
And so now we've got coconut oil and affecting ice cream.
There was Dijon mustard gate there a couple of years ago.
Oh, that is true. Yeah. So it's an interesting one. It's are we just more cognizant of these stories post-COVID because everyone's thinking about international supply chains, or are we seeing more climate-affected supply issues? Well, I think we should acknowledge that all of the industries where we've seen these things are industries where supply is really consolidated to a local area.
Yeah.
Coffee, South America and Brazil, and particularly Brazil, coconut oil, the Philippines, chocolate, West Africa. But it is something that I think we're definitely clocking more of.
Definitely. Absolutely. Well, to stay up to date with all of the headlines, make sure you subscribe to our daily newsletter. 6 a.m. every day, we send you a summary of the most important business news from around the world so that you can stay informed and up to date with what is happening. It is time for
Pimp My Portfolio. Pimp My Portfolio.
We have a community member on the line who has submitted their portfolio for review by an expert here in the studio. Our expert is none other than Luke Laretive. How are you?
Bryce, Ren, good to be here.
And on the phone, we have John. John, welcome to Equity Mates.
Thanks for having me.
Now, John is actually from Wagga.
Nice.
Bonus points.
Him and I go way back. bonus points. Yeah. So, John, tell us a bit about yourself.
Is he your cousin or something as well?
Yeah. I'm originally from Wagga. Yeah, that's right. Live in Sydney now. I work in consulting in the property industry.
Nice.
And I suppose I'm probably a bit earlier on in my investing journey than you guys, but
I'd hope so.
Along the way.
Love it. Love it. Well, we're going to get stuck right into it. Ren, take us through John's portfolio.
Yeah, so John's portfolio is made up of 2 ETFs and then 15 individual shares. The 2 ETFs are the iShares S&P 500 ETF, IVV, and the Vanguard MSCI International Shares ETF. Together, they're 15% of the portfolio. And then if I just go down the names of individual stocks in alphabetical order, we've got Australian Clinical Labs, AGL, Ampol, Austal, Horizon, Deep Yellow, Elders, Electro-Optic Systems, Grain Corp, NAB, Trajan Group Holdings, Wesfarmers, Biogen, GoPro, and Trivago. So some international stocks, some Aussie stocks, some big, some a little smaller.
I bet I know why GoPro's in there, but I'll bring it up at the end.
Okay, well, save that because, Luke, do you have a nickname for this portfolio?
Yeah, the only thing I can think about is, Dr. Evil from Austin Powers. Maybe I'm showing my age, but, watch out for the laser for his EOS.
All right, to be fair to Luke, we didn't give him a lot of time to come up with a nickname for this one.
I've got nothing for you.
So, John, can you tell us a bit about how this portfolio came to be?
I started with those VGS, I think, ETF, and Wesfarmers, AGL, and NAB when I started. Just sort of some large companies that I knew. I suppose from there, I've just done a bit of reading, listening to the podcast, and have sort of stumbled across, I suppose, the other holdings through various conversations and reading. So that's sort of where I'm at.
And what we're just thinking, like a grand into it, just dartboard, no thoughts to like how you put the portfolio together. More so, just like I like that name, and I spend this amount of money on each stock, so therefore I'll just have a go. Yeah,
well, I suppose it sounds simple, but I started like that, and I was very green, and I'm sort of starting to, I suppose, get some more literacy around.
Yeah, cool. It's just good to know.
Yeah.
Luke, before you give your thoughts, I'm curious about Bryce's bet that he's put on the line with GoPro.
Oh, GoPro. Was that a sign-up bonus from Stake?
Yeah, and Trivago.
Well done.
Yeah.
I think they're less than. I think I don't even have one whole share in GoPro anymore because they're very small holdings.
John, I'm interested in one of your holdings, ACL, Australian Clinical Labs. Can you tell us a bit more about that?
The thesis for that is the aging population. Hopefully they'll need more pathology and that kind of thing. So
yeah, right.
Nice.
So I think my feedback on not ACL necessarily, but just like picking stocks in general is don't do it on the back of like big macro sort of trends that you think they've got exposure to or don't have exposure to. Like everybody knows that old people need to go use healthcare. There's no edge there. There's no value there beyond what's already in the share price. So you can look at it. If you're looking at if you're going to pick stocks, I think, as a base sort of, very, very basic start point, you want to look at revenue. You want to look at profit, margins through time, have some sort of concept of where you think those metrics can go into the future and what other companies are doing with those same sort of basic metrics and how much on a valuation basis you have to pay for these companies. So I'm not saying anything about ACL or any of these companies, to be fair, but I just think that buying stocks on this sort of these macro, it's very, very fraught with danger. It might work out, it might not, but I can probably tell you that it won't work out long run. You'll buy a lot of shitcos that seemingly have a good narrative, but aren't actually good investments. So remember when we're investing, we want to be buying something that we think's worth $2 that everyone else thinks worth $1, not the other way around. And if you're just relying on sort of broad-based narratives that everybody else understands that are just clear and obvious, it can get you in trouble. It may not get you in trouble with ACL, but it might get you in trouble with something else. So just as a concept, I'd be careful there.
Sure.
And the other stocks that you've picked, you're not kind of going into the weeds with each company. You're thinking, I like uranium, so I've bought Deep Yellow. I like defence, so I've bought EOS and Austal. Is that sort of the vibe?
Yeah, that's the vibe. Yeah, that's what I'm doing.
Yeah,
nice. That's the vibe.
So John, I'm going to be very mean to you because I'm hungover, and I'm going to say
on a Tuesday morning.
I went out
Caught him out.
Went out for dinner with my mate in Sydney last night.
Oh, yeah.
And those margaritas will get you. They will. I think the vibe here is let's not pretend to buy things because we know where we're buying them, and let's try and do things with a bit more system and process. I think if you want to pick stocks and that's what you want to do, you've got to like some skills obviously with your job. I would be narrowing your universe down to a very small subsector of stocks that you exclusively invest in that you're interested in. If you love healthcare, because I can see you've got Traditional in here, which has been a bit of a disaster, or you love the energy sector and you say, okay, I'm just going to invest in servos and utilities providers, or not that I'm recommending you should pick these. I'm just giving you some concept. Defense. I'm only going to invest in defense companies above $1 billion market cap or below $1 billion market. Give yourself some parameters to spend your time researching and try and get really good at like one part of the market, like you would if you worked at a fund manager and I said, okay, mate, you're covering XYZ sector of the market. I want to know everything about every single stock in there. So don't try and be a generalist until you've been a specialist, if that makes sense, because there's a lot of transferable skills you'll learn.
Would you then maybe look at upping the ETF portion of it and having more of a satellite approach? Or
Yeah, I think with the kind of level of skill that you kind of talking to me with at the moment, and I'm not trying to be mean to you. I'm sure you're great at your job. I'm sure you're great at lots of other things, and I'm sure you'll get better at this. But I would probably recommend either employing an active manager or two, or going to an ETF more focused portfolio for your wealth, for your personal wealth, and using this little sector that you're going to work on as a way for both to the personal improvement, and potentially down the road, you can start applying some of those skills to more meaningful amounts of money to you, if that makes sense.
Yeah, cool.
Yeah, I would do that, and it's just kind of, maybe just trying to exit these things in some semblance of, sensible.
So I guess, John, for any of those companies in there that you're not like wholeheartedly, high conviction, you could probably sell down, start building that core position so it's a little bit more meaningful in terms of weighting. I think what Luke is saying, and then focus in on a few sectors that you're really loving.
$600 in Horizon, like it's just not gonna. 1% in a 3, it doesn't matter. Like it's not going to matter. You just don't. That stock's not going to move much. So you don't need to have that in your portfolio if you're just having a small satellite with a handful of your favourite stocks. Go and buy something that you think can 4x. Like that's sort of the.
Yeah.
Well, are there any stocks in this portfolio that you do quite like?
That I like. Do I own Ampol because I like it? No, I own it for benchmark management.
What about West Farmers?
Nah, that's so expensive, bro. I'd be selling that. Yeah, no, I don't like any of these companies.
Wow. Luke goes bang.
Ouch.
Well,
But you're in
like Elder's okay. Elder's okay. Like 6.5 out of 10, 7 out of 10.
Okay.
Everything else kind of sub 5 and wouldn't own.
Well, John, as Luke said, he's a bit hungover, feeling a bit.
Sorry, John.
Do you have any other, questions, or if any, particularly about some of the stocks, or just generally about, where to from here?
No, I think from what Luke said, I might sell it all and start again.
But you don't have to. Like, there's no, like I said, if you like what you're doing and you're enjoying it,
that's the other thing. If you're enjoying it,
it's not. But it's money. It's real money. Like if I said to you, we're going to go to the pub and we're going to spend $1,000 on beers, and you're shouting for the night, you're not going to be happy about it. You know what I mean? So I think this core satellite thing that everybody's doing, it's an emotional hedge. It's an idea that, I can be socially and personally allowed to gamble and have a go at things and buy a few lotto tickets. And as long as you're doing it, and it's like gambling, as long as you're doing it responsibly, it's okay. But it's not investing. It's not managing your family's wealth. It's not working towards your goals. It's detracting from all those things, and you're deciding to do that because it's enjoyable. And that's okay. I've no dramas. But I think if you are trying to genuinely build wealth, you are trying to work really hard, save your money, do all the good things that you're supposed to do, I would treat every dollar that I've got equally. I would treat them all with the best possible insight, intelligence, IP I could find anywhere on the planet. So, and I could access.
Yeah. I don't think, let's not throw the core and satellite baby out with the bathwater here. Like what the principle of it is you have a fair chunk of your money in the index, and then you try and do all the work to try and beat the index. But it's an acknowledgement that only like 15% of active managers do beat the index consistently over the long term. So who are we to think we can be in that 15%?
And that's easy to say when you take every asset class and you roll them all in together. It's an easy stat to throw out. It's not really right though. So, if you talk...
No. Just large cap, just large equities.
I think that stat I don't think is large equities. I think that includes bonds as well.
No, bonds active do outperform.
But I was going to say that the bonds actives do outperform. So it's
I'll pull up the Spiva scorecard for you from S&P Global after this.
We hate Spiva.
But look, John, thank you for submitting your portfolio. I think the fact that you're investing and getting started is a great
for
start.
Sure. There's no,
and there's always more to learn. There's always more to do. So. Hopefully we can get your portfolio in front of Luke in years to come, and he won't be hungover when he looks next time.
4 more zeros at the end of it.
Thanks for having me, guys. Appreciate it.
If you would like to speak to Luke or any of the other advisors and put your portfolio in front of them, head to equitymates.com/advice, fill out the form. Likewise, if you would like to submit your portfolio like John, head to equitymates.com/contact, and there is a form to fill out. But Luke, pleasure as always.
Pleasure, mate.
The world's largest asset manager has just bought $25 million worth of this stock, and it got us wondering what is going on with Generation Development Group. And Ren, that is the stock that I want to talk about today.
Yeah, well, what's going on with it is you are notable for your love of swimming. The Olympics, not just
true.
the Olympics, like the Australian World Championships. You've been following James Magnussen, the missile, and his enhanced games. You want to follow his course of treatment. So I'm not surprised.
Need if you're watching on YouTube.
I'm not surprised that you're interested in Generation Development Group because it is headed up by swimming legend Grant Hackett.
It is. He's the CEO. Might try and get him on the show, actually. But anyway, that's beside the point. Look, this company's come across my desk for two reasons. Obviously, I saw the headline that BlackRock has invested $25 million in the company and have a strategic alliance now to start distributing and building more product together. The second is around the superannuation changes. And I was reading that there is already they've already seen a large shift in uptick for products like what Generation Development offer.
The superannuation changes you're talking about are the tax increase for balances over $3 million.
That's correct.
Yeah.
Yes.
Okay, so people are looking for tax-effective investments by the sound of it. So what does Generation Development Group do?
So they're focused on tax-effective investment solutions. They're listed on the ASX. As I said, the ticker is JDX. But
ticker is GDX.
GDX. But it's broken up into a few different sort of segments. The first is the Generation Life business, and this provides investment bonds, otherwise known as education bonds. They're a market leader, and these are effectively tax-effective investment products.
If you hold them for 10 years, you get a 30% tax rate.
The income within it is 30%, and then if you hold them for over 10, I think the capital gains, you can withdraw it tax-free.
Yeah, okay.
Yeah, so particularly useful for high income earners and those that can sort of park cash. But it's a reasonably sized market. It's a $9 billion market here in Australia. They also have a life income product called Life Income, and this is where they're trying to tap into the retirement space. So it's a lifetime annuity product that guarantees income for life with investment flexibility, and it's a $566 billion market. Then recently they have acquired a company called Lonsec. So they originally owned about 60% of Lonsec. They then went out and bought the remaining amount. It's Australia's largest investment research firm, I should say. And they help with administration, research, product development and the like. And it's a sort of a recurring revenue model for the business.
But basically, most active fund managers will try and get Lonsec and Zenith ratings and Morningstar, but the big two are Lonsec and Zenith, and that then opens up institutions and advice houses to be able to invest in them.
Yes. Very important player in the financial industry here in Australia. And then finally, they have a fund administration business that kind of wraps up into that, where they provide admin and reporting services for clients around Australia. So that's the business. The question is, what is the opportunity, or like why is it of interest? Let's start with the retirement boom. So as I said, it's a $566 billion market. It's expected to hit $1.2 trillion by 2030. And Generation Development are right in the middle of it with their life income product. It's gaining traction, it's gaining customers, it's gaining inflow of product. So I think we think about the demand for income products as Australia's population ages is only going to increase. I think it's a pretty strong tailwind, and they're positioned right in the middle of it. But the interesting part is the superannuation part, something I think it's very early to tell the impact of the government regulation on how it's going to shift money. But you could make a judgment that if there's no real major tax difference between having it in super and out in terms of the 30%, then excess money might start looking elsewhere.
Yeah. I mean, look, there are two big differences. On one hand, you still get a more favourable tax treatment going into super.
Yeah.
You get, if it's under the concessional cap, compared to just being taxed at your marginal tax rate as income.
Yes.
So that's an argument to still use super. The argument against still using super is the tax on unrealised gains within super. That wouldn't be mirrored in the insurance bond product.
Yet.
Yet. Well,
Yes.
I mean, we can only go off what we
Of course, yeah.
know. Yeah.
So Generation Development are really positioning themselves now as the go-to alternative for superannuation, and it is through these investment bonds, which really, as we said, long-term products that allow you to park cash tax effectively, designed for sort of the high net worths, but I guess more and more being marketed towards retirees as some sort of alternative. The new regulation, there was an article recently saying that some major players, including Generation Development, have reported an increase of 50% into these new investment vehicles since the announcement of the government superannuation changes. So a pretty significant increase in inflows. And so they're really now focusing on doubling down in this space and starting to provide more products. And then on top of all of that, you've got the Lonsec opportunity, which again, as I said, big sort of research house, but providing sort of cross-selling opportunities, expanding product pipeline, new research, new products, really underpinning what's going on in the funds management side of the business. And I think Lonsec is pretty much all recurring revenue for the business as well. They see this as a meaningful contributor to profit going forward. That's the opportunity, Ren. If I put some numbers to its growth story over the past 5 years, so FUM has grown at a compound average growth over the last 5 years of 27%, going from, it's currently managing 3.3 billion. One of their large target markets is advisors. They've been able to grow their advisor customer base at 20% a year for the past 5 years. They currently have just under 2,500 advisors. There's about 12,000 active advisors in Australia.
15 is the number, but
15.
yeah.
So pretty big opportunity to continue growing there. New bond policies.
I mean, yeah, that's one way of saying it. Or the other way of saying it is like they've already got like 15% of the market
True.
of advisors. But yeah, true, yeah.
I mean, aim for the stars. They've grown bond policies by 35% a year for the past 5 years, and their life product in terms of new money invested, they've been able to grow at 30% a year for the past 5 years. In FY24, they took on new money of $657 million. So pretty strong growth numbers across the board in their major parts of the business.
Nice. Okay. Well, I've had a look at their share price and it's up 150% in the past 12 months and up like 800% in the past 5 years. So I'm sure there's got to be some good revenue and profit numbers behind that.
So the revenue for the past 5 years as well, they've gone from 195 to 368 million. So that's CAGR of 25% a year for 5 years. Their trailing 12 months though is 558 million. So another 200 million on what they reported last year. So that's some pretty significant growth there.
But that would include the Lonsec acquisition.
Yeah. That was in 2024.
Yeah.
Yes, correct. And then underlying net profit has gone from 2.5 to 11.3 million. So that's CAGR of 45% for the last 4 years as well. They do their statutory profit when they actually reported in their annual reports is 5 million.
Yeah, I found it interesting that you did underlying net profit.
Yeah.
So I did have a look. Yeah, it's growing. You know, they made a loss in 2020 as everyone did. As a lot of companies did with COVID. But then, 2.5, 2, 4.5, almost 6. Like, you know.
Yeah, it's growing.
Yeah.
So I think, look, opportunity, very big target market in terms of the retirement. And I think this shift in the superannuation industry, we know how much money is sloshing around there. It'll be interesting to see how it plays out.
Nice. So do you own this company?
No. As I said, this is just something that I literally just was interested to know what this company does because I knew Grant Hackett. It had been in my orbit. I knew Grant was the CEO. We'd spoken about it, but it wasn't until I saw the headline BlackRock and then saw all these articles about the change in fund flow that's already occurring.
So the notable thing though is those profit numbers I just gave were annual profit numbers. In their most recent reporting season for the first half of this financial year, 79 million in profit.
Whew.
Yeah.
Well, there you go. That's got to be Lonsec.
Yeah, I think so.
Because they were really in their most recent annual report. I fed their last 5 years into Notebook LM.
Yeah.
And there was a big chit chat around Lonsec contributing to profit. That was one of the main drivers for it.
Yeah.
Wow.
So it's
where profit goes, share price goes.
There you go. I mean, how can we say anything after that? Look, yeah, interesting one. Grant Hackett doing the damn thing. Good on him. and certainly one to watch. The retirement boom is going to, it's going to make some companies a lot of money, and I'm sure it will also bring a lot more competition into some of these spaces. So it'll be one to watch to see how the market plays out.
Yeah, might add it to the portfolio. We'll see. But anyway, we love hearing stocks from you guys as well. So come and join us in the Facebook discussion group where we are talking about what we're buying, what ETFs are going in people's core portfolios, plus a bunch of other stuff. And we love hearing your feedback too. So if you could leave us a rating and a review wherever you're listening, if you could leave us a comment below on YouTube, we do really appreciate it. We read all of them and love hearing how we're going.
All right, well, that will do us for this episode. Make sure you subscribe wherever you're watching or listening. But Bryce, we'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.